Corporate transactions have hit a dry spell. After a blockbuster year in 2021, mergers and acquisitions stalled in 2023, though by the summer, bankers like Evercore's Ralph Schlosstein were hoping for more action in the second half of the year.
Announced M&A for the first 6 months of the year was down, the dollar volume was down 40%. I don't expect it will be quite as bad in the second half of the year, but certainly the amount of dialogue among our clients is up quite dramatically, and our backlogs are up.
And there were some areas where things did pick up, like on international deals.
This year was very busy for us on cross-border M&A, so we're seeing companies listed outside the U.S. just migrate to another new listing here and turning it into their primary listing, getting a multiple bump. But we could also just see a lot of U.S. companies spending their cash overseas.
And as we get into 2024, there's reason to believe there's the appetite out there, whether it's from private credit.
If you look at the likely demand for private credit, if you take the $2.4 trillion of dry powder in private equity funds, and you assume $5+ billion of deals, there's an enormous demand for private credit.
Or in tech, where valuations may be making deals more compelling.
I do think investors have more confidence in the levels that we're at from a valuation standpoint more broadly in technology, and are starting to see the competing tension in the public market of M&A from strategic, take privates, for example, or from take privates or from strategic activity leading into the end of this year.
But when you talk with the bank leading the league tables in M&A, Goldman Sachs, there remains a big difference between the interest and appetite and the deals making it over the finish line.
When you think about what really drives future M&A, we think there's a lot of pent-up demand. The pipeline of dialogue is as robust as we have seen. What the challenge has been is just getting the fingers to meet on transactions.